Hi, this is Adam Khoo here, and we are into week 5 of the bear market, the COVID-19 pandemic bear market. And we actually hit a low right here at the minus 36% mark, which is 36% below the all-time high of 3393 on the S&P 500. Since we hit that all-time low, we have kind of like rallied up to this level over here, where we still remain roughly about 24% below the all-time high. So the question is, have we seen the bottom? And can stocks only go up from here? Let's explore this in this video. But before I begin, important disclaimer. No one can predict the future. I'm not a fortune teller. I can't predict for certain. All I can do is I can look at probabilities. Is it more probable that we have bottomed and we're likely to go up, or is it less probable? And based on probabilities, we can take intelligent investment decisions. That's the first thing. That's the first disclaimer, right? The second thing is when we attempt to time the market bottom, we can't always time it to the exact day or minute or hour. I love to, but it's almost impossible unless you're lucky all the time. But what I found is in the past, I've been able to time the bottom of bear markets as close as possible, but sometimes I'm off by about a month or two. And I'm going to show you that it doesn't matter whether you're off by a month or two, but as long as you are close enough to the bottom, you can make great decisions to build your fortune once the bull market arrives. All right, so with that, let me show you how I determine the probability that we have actually reached the bottom of this bear market. One of the things I do is I look at many different kinds of indicators. And one of the most effective indicators I found in calling bottoms of bear markets are a combination of two indicators. The first indicator is the Williams R indicator, and I'm using the 52 setting, right? So again, I'm looking at the S&P 500. I'm looking at weekly candles. They work best on weekly candles. So why 52 on the Williams R indicator? Because 52 weeks is 1 year, okay? Now, the Williams R indicator was invented by Larry Williams, one of the best traders in the world. I respect him tremendously. And he came up with this indicator to tell when markets were overbought or when they are oversold. All right, so obviously, if we're looking for a bottom, we're looking for the Williams R indicator to be oversold. So how do we know it's oversold? So looking at this indicator, you can see that we've got an upper boundary, which is the minus 20 boundary, this dotted line over here, and we've got the minus 80 boundary, which is this dotted line over there. And of course, we've got all these squiggly lines. So we're looking for this line to go below minus 80. So for example, you see this here? That's all below minus 80. So this tells you that the market is oversold on a 52-week time frame. And when it's oversold, it's like a rubber band stretching it down. What's likely to happen? That's right, it's gonna bounce back up again. But I found that just looking at this is not reliable. Why? For example, let's go back 20 years. This was the year 2000 to 2003. This was a bear market, as you can see over there. This was about 2.5 year bear market. Now, if you just look at the Williams R, you would have gotten a buy signal over here, right? Because it was below minus 80. If you bought over there, guess what? It went lower. You got another buy signal, bought there, went lower. Another buy. So, it's not really good at, picking the bottom because it gets oversold, but even more oversold. So we can't just use that by itself. So what I do as well is I look at this other indicator that tells me the average true range that has been normalized. Now, what's average true range? Average range refers to the range of the candles or the daily, in this case, the weekly volatility. I don't know if you noticed that when the market's going down, the closer it gets to the bottom, the bigger the volatility, the swings during the day or the week. If you notice, for example, about a week ago, right, when the market was like at minus 36%, of the all-time high, the market was swinging, 7% one day, 7% the next day. So the ranges were very, very wide. We call that really high range days, where ATR exploded, average true range exploded. Okay, so this indicator tells us when the range is abnormally big. Abnormally big. All right, that's right. Okay, so you see this dotted line over here, this orange dotted line. Okay, that's the 80 line. So anytime the ATR is above 80, the ranges are abnormal. Okay, so when is it above 80? There. Can you see that? Okay, great. So we've got two indicators now. We have got the Williams R, and for Williams R, we are looking at it to be below minus 80, correct? For the ATR nominalized, we are looking at it to be above 80. Now, here's the thing. To call a market bottom, both of them should show us their signal at the same time. In other words, we want to see that the Williams R is below minus 80 and the ATR nominalized is above 80. When they both happen at the same time, we are very close to a market bottom. Okay, so let's go back 20 years and look at all the bear markets and see how reliable this indicator was. Again, going back to the year 2000, that's when this bear market started, the dot-com bust, right? Dot-com crash. And you can see the market bottomed here. The market bottomed in mid of 2002, right? Now, look at something interesting. When did both indicators coincide? That's right, at that point. Can you see that the Williams R was below minus 80 over here, but it wasn't a bottom signal because the ATR was not above 80. Okay? Now, over here, check it out. The Williams R went below minus 80 and the ATR went above 80. So we have got those two indicators coinciding, and that called the market bottom to the exact week. All right. So if once you get these two signals and you start to accumulate shares, you'll be pretty happy. Does it make sense? All right. Pretty cool, right? Now, of course, this could be a one-off fluke. So we got to see, did it work in other bear markets as well? So what happened after that? So after that bear market of 2002, the market then went on, right? Market went on. So where was the next bear market? There we are. So the next bear market was this, boom, okay? And that was the financial crisis that started in October 07. And where did it bottom? Okay, let's see where it bottomed. Let's just move the a little bit over here. Okay, so it actually bottomed here. It bottomed in February of 09. So did our indicator work this time? Okay, let me just zoom it in and you can take a look for yourself. Let's just stretch it a little bit over there. Okay, so once again, market bottom was here, February 09. Okay, so where did our indicator indicate the bottom? All right, so again, you can see Williams R went below minus 80 starting from here. And we know that's not accurate because if you bought there, you would have died as well, right? But you can see that at this point, the ATR did not go above 80. Okay, now the ATR went above 80 here, but this wouldn't have been a buy. Why? Because the Williams R was not below minus 80, so they're not coinciding. They got to coincide. Got it? Right. So where did they start to coincide? They started to coincide here at this point. So there you have it. We have got the Williams R below minus 80, and we have got the normalized ADR above 80. So the market bottom was called actually here at this point, right? So if you started to accumulate shares and say, okay, that's the bottom over here, and you started to accumulate shares over there, would you have caught the exact bottom? No, you wouldn't have, because it went up a bit and came down again to make a second bottom. Can you see that? So like I said, this technique, you can't call the exact bottom at the exact week, at the exact day or hour. You may be off by a month or two, but question, does it really matter? It doesn't matter. Why? Because if you started buying shares here, what would have happened? Okay, let's move our charts over there. Okay, so if you started to buy shares over here, yes, it went lower slightly, okay, but within the next 2 months or so, would you have been very happy? Yes, you have caught the next bull market. Remember, after every bear market is the next bull market, and you can't always catch the bottom. You don't have to, as long as you are near the bottom. And that's why I tell people that once this indicator shows us we're near the bottom, please don't buy all in one day, for goodness sakes. You know, just buy a bit first and just average in. So every week you just buy more every week. So even if you're off by 1 or 2 months, it doesn't matter, but you get in near the bottom instead of getting in here and getting this big crash. You get in there and you're really happy. Got it? Okay. When was the next bear market? Okay, now this was not really a bear market. Well, it was, but it was a baby bear market like this one over here, right? So you can see that this was a drop over here. Not, well, it was a very small bear market. And sure enough, did we get the signal again? Yes, we had Williams R going below 80, minus 80, sorry. We had ATR going above 80. So we had that buy signal again over here. So you could have, again, bought over there. So if you bought over there, would you have been happy buying over here? Let's see. Well, yeah, pretty happy. Okay. So getting in over there, you'd have again caught the next really strong bull market. Very, very powerful, right? Okay, so let's move on. When was the next bear market? So again, going to the right, and this was a bit of a sell-off, not really a bear market. Now, the next big bear market was actually there. This was December 2018. Is that correct? Yes. December of 2018. You can see that was a minus 20% drop bear market. And did we get a buy signal again? Yep. Williams R went below minus 80. ATR went above 80. Yeah, it's really small, but it went just above 80 over there. Check it out, just above 80. Just touching it. Okay, so that would have been a buy over there. Okay, so would you have been happy buying over there? Let's check it out. Ready? Oh yeah, pretty happy. You have caught that next bull. And of course now we've got the COVID-19 black swan that just hit us like a ton of bricks. Boom! Down again. Alright, so again, we can't predict when the next bear market will come, but we can tell where we've hit bottom. So 1 week ago, again, let me just zoom this in a bit, right? Let me just make it bigger. Okay, there we are. Okay, so a week ago, we plunged to the bottom here at 2003 on the S&P 500, right? Like I said, from the top to the bottom, it was a 36% drop. Guess what? Williams R went below minus 80. And ATR went up above 80 to a crazy 120. So this signaled a potential bottom of the market at 2,300 points. Now, coincidentally, if you have watched my bear market survival guide, you would have remembered that in the last 100 years of 21 bear markets, the average bear market, as you can see, average of all the bear markets was a drop of minus 36%. Coincidence? I think not. I don't know. Maybe it's a coincidence. Maybe it's not, right? But that's something interesting. Now, the other thing I find interesting is that Now let's zoom in a bit closer, right? I've been showing you the weekly charts. Now let me just zoom into the daily charts over here. Let's go to the daily charts. All right, so these are the daily charts. So you can see that big plunge all the way down. Again, this is the minus 20% level. And this is the minus 30% level. And again, we reached the minus 36% level over here. Okay, so the moment we hit that level, we started rallying all the way up, right? This was very, very strong rally. Now, here's the interesting thing. We did not rally on good news. We rallied on bad news. In fact, we rallied on the worst possible economic news that we could have gotten. In fact, it was the worst news in the history of the US markets. What was the news? The first major bad news that happened over here was that jobless claims was 3.3 million. And then just yesterday, we had the news reporting that jobless claims was 6.6 million. So imagine 6.6 million Americans are out of a job. Now, that's the worst economic news you could ever think of. And guess what? The market went up. So what does it tell you? See, bear markets don't die from good news. They die from bad news. So once you see bad news coming out and the market no longer goes down, it tells you that the market has already expected the worst case scenario and nothing more you say can get it to go down. Another thing the market is telling you is that everyone who has needed to sell out of desperation or panic have already sold. So there are hardly any more sellers left. And those who have sold, they're in cash right now, which means there's a lot of cash in the sidelines, which means that when the cash comes back, that would drive the market higher. Now, a lot of people will be thinking, Adam, how can the market possibly go up from here? How can it bottom? The economy is going to get worse. More people are going to get infected. We're just at the beginning of that infection curve. More people are going to die. In fact, the number of deaths is only going to peak somewhere in mid-April or mid-May. More people are going to lose their jobs. Now 6.6 million are unemployed. They're now looking at possibly 25% unemployment rate in the next few months. More people are going to go out of business, right? Yes, I don't deny the fact that the economy is going to get worse. More people are going to die. More people are going to get infected. I know that. But remember that the stock market is not the economy. The stock market moves 6 to 9 months ahead of the economy. The stock market is a leading indicator of the economy. In other words, the stock market doesn't care what's happening now. The stock market only cares what's happening 9 months or 6 months from now. Make sense? Now, a lot of people always think, hey, I will only start to invest when the economy recovers. I will start to invest when the epidemic is over. The trouble is the stock market will tend to rally and go to all-time highs way before the economy recovers. The market will start to move up way before the pandemic is over because the market moves ahead of the economy. So that's one thing you gotta understand. Now again, remember my disclaimer. I'm not saying that this is the absolute bottom. It could be, but again, we could be off by 1 or 2 months, which means that could we in fact, let me just go back to the charts on the weeklies again. Could we in fact, for example, could this be a short-term rally, or we call it a dead cat bounce, where you bounce to, maybe 2630, there's a strong resistance, and we go back down again? Yes, that's indeed possible. In fact, if it goes down again, I'm looking at it to go to probably the 2000 level. In other words, the first bottom was 2,300. If we do go down again, we could possibly hit the 2,000 level. Okay? And that would represent, from the top to the bottom, a minus 40% bear market drawdown. Which, by the way, if you look at my charts again over here, you can see that the average of all bear market drawdowns was minus 36%. But with a recession coming, it could be 42%. So again, it's plus minus 5 to 6%. So the important thing again as an investor is, even if you start buying over here, don't buy all in. Just buy a bit. average in the market. So you just buy a few shares, right? You just get averaging in every few weeks. So we do come back down again to another low. Hey, that's good news. You get to buy more at a cheaper price. So you just average more in again. Now, it doesn't matter if it goes down another 5 to 6%. You know why? Because once the bear market is over, the bear market is dead, the next bull market will begin. And the next bull market, I can guarantee you, will not go up 100%. It's going to go up 2, 3, 4, 5, 600, 800%, like all previous bull markets. Why? Really simply, because of the Federal Reserve. This is the election year, and the Fed and Trump will do whatever it takes to pump the market sky high, and they've got the means to do it. Remember, the Federal Reserve can do whatever it takes to pump the market up. The market is rigged. It's rigged to go up. What can the Fed do? Well, the Fed cut interest rates to zero. They could even go to negative interest rates. They've launched unlimited quantitative easing, which means they're printing money like there's no tomorrow. And with all this money, what does the Fed do? They buy bonds, they buy treasury bonds. But now they're buying corporate bonds, and the Fed has even said they're going to even resort to buying stocks. So imagine if the Federal Reserve starts to buy stocks, nothing can stop them. They can push the market to all-time highs. So what does it mean? When interest rates go to zero and the Fed prints money, it means in the long run, the value of the dollar will keep going down, which means if you hold cash, it's going to be trash. All right? In the long run, as you print money, what's going to happen? It's going to lead to the rise of asset prices. That's right, we call it inflation. So property prices are going to rise. Stock prices are going to rise in the long run. So in the long run, investors will get richer and richer. People who save cash under their pillow will get poorer and poorer. And all the more, that's why you have to learn how to invest. But again, remember, when the bull market comes back, not all stocks will rebound. Stocks of companies that have been badly damaged by the crisis may never recover. So avoid stocks whose earnings and sales and competitive advantage have been damaged by the crisis. For example, I avoid energy companies, oil and gas. I'm going to avoid them. Avoid airlines. Avoid semiconductors. Avoid those stuff that are really competitive that have been hurt by the economy. I invest in recession-proof, virus-proof stocks like Microsoft, which is benefiting from cloud computing. That in fact, cloud services increased 700% during the lockdown. The more people stay in, the more they play online games. Look at gaming companies, online gaming companies like Tencent. Look at my previous videos on coronavirus-proof stocks. Those are the stocks that are going to rebound faster than any other stock. All right, so I hope you learned something here today. It's Adam Khoo. Like I said, I'm not a fortune teller. I can't predict the future. For the last 26 years, I've been in the markets. I've made my fortunes calling market bottoms, but I don't call the exact bottom the exact day. I don't have to. As long as I'm around there, plus minus 5-6%, plus minus 1 or 2 months, I'm making enough money to build my next fortune, and so can you. I hope this has helped you. Do subscribe to this video or do subscribe to this channel for the latest videos. At the same time, if you like to learn a lot more about how I read the markets, how I analyze, and how to use all these wonderful indicators, join my value momentum investing course called the Whale Investor, or my professional stock trading course, where you can learn how to generate an income from anywhere in the world, even at home. This is Adam Khoo signing off. I'll see you soon. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.